7%, 10%, 25%, 61% returns with no downside risk. In this episode, I'm going to address the question how to get high investment returns with no or very little risk. Get ready. This is going to blow you away. So my name's Doug Andrew. I've been a financial strategist and a retirement planning specialist for more than 47 years, and I'm just going to cut to the chase. One of my favorite vehicles to help people accumulate their money tax-free and then later be able to access their money tax-free. And when I say later, actually any time, even a few months later, but most people came to me as a retirement planning specialist. So this was later down the road for their retirement or golden years where they could access the money tax-free. And then when they ultimately passed away, whatever they left behind blossomed in value and transferred income tax-free. And that vehicle is what I call the laser fund. Now, if you stay with me to the end of this episode, I want to gift you a copy of my most recent 300-page best-selling book. It's flying off of the warehouse shelves. Several hundred a week go out, and I want you to be able to claim your free copy so you can learn how to diversify and create the foundation for a tax-free retirement. Do I recommend you have 100% of your money into a portfolio of laser funds? No, even though we've had some clients do that and we've taken them from the highest tax bracket down to a 0% tax bracket. But I would recommend that between 40 to 60% of your retirement income not even show up on your 1040 tax return. The IRS will know you're receiving it, but it's tax-free. There's nowhere on a tax return to put it. So let me show you a few glimpses into what the laser fund does, and then I want you to claim your free copy here at the end of this episode. So what is a laser fund? It is an MFTA insurance contract. MFTA means max funded tax advantaged, an insurance contract where you are designing the insurance contract, usually a max-funded life insurance policy, the opposite way that most Americans structure. In other words, a lot of people will buy life insurance for death benefit. I'm talking about using it for living benefits, which is really the idea behind the emergence of universal life by E.F. Hutton, who was the brainchild of universal life, and they weren't even an insurance company. They realized in the Internal Revenue Code, sections 72E, 7702, and 101A, that an insurance contract is the only vehicle that allows you to accumulate money tax-free, be able to access the money tax-free all through your retirement, and when you ultimately pass away, anything left in there will blossom in value, increase in value, and transfer income tax-free. And so they said, let's take the least amount of insurance we can get away with by the IRS and put in the most money the IRS allows, and it turns into a tax-free cash cow. You can learn how that works on this very channel. Subscribe to this channel, by the way, and click the little bell because you'll be notified every time I post an in-depth answer to a financial question. And I have over 500 educational YouTube videos on this channel. But stay with me to the end because I want to gift you a copy of my most recent best-selling book, The Laser Fund. Now, when I have an indexed universal life policy, I like to use indexing. I'm going to simplify this here first of all, and then I'm going to show you why it knocks the socks off of most investments and where people have been able to lock in gains of 25, 30, and 61%. If I have $1 million of cash value, and sometimes people are socking away $500 a month into these for 30 years before it's grown to $1 million, or sometimes people put in $100,000 a year for 5 years, and the 500,000 doubles to $1 million in 7.5 years. We've had many clients who have done that. I'm just talking about a snapshot in time. If you have $1 million of cash value right now in a max-funded insurance contract, a laser fund, the insurance companies, as of the recording of this episode, are earning on their general account portfolios maybe around 4 or 5%. They need one of those percentage points for themselves. So you can hunker down and play it safe and just say, just pay me 4% this year. That would be $40,000. Or If you feel bullish about America, like I usually do, I tell them, you know what? Keep my million safe in the insurance company. Don't put that at risk. But take the 4% you're earning, the 40,000, and fund an options budget. Now, the insurance companies, they buy options on an hourly basis. They're the number one purchaser of options in the world. And so what they do is they take that 40,000 and they buy upside options in the index or indices that I choose that they offer. Most of them offer 10 or 15. It could be the S&P 500, the Dow Jones, the Russell 2000, the Barclays US Dynamic Balance Index, or I can diversify and have 20% of my million in each of 5 different ones if I want. What are they doing with that? They're buying upside options, so if the market goes up, that 40,000 of options doubles to 80,000 or triples to 120,000, which allows them to be able to pay you whatever the index does. They're big boys and girls. They know what they're doing. They can afford to do it because of the options. But what if the market crashes? I don't lose my million. Okay, my million is safe. The options expired worthless. And so zero can be my hero. The years that the market crashes, I may not earn anything. I earned zero, but I didn't lose. And so this allows companies to credit me up to either a cap or no cap, as you're going to see here. That's how indexing works, and there's other episodes on this channel that will help you understand this in more depth. But let me go into actual reports of what people have earned, okay? Based upon the worst decade since the Great Depression, 2000 to 2010, even let's go to 2012, most Americans lost up to 40% twice during that decade. If you look at this, a lot of people who maybe had $1 million in November of 1999, they saw that $1 million dwindle after the 9/11 terrorist attacks for 2001 to 2003 down to about 600,000. It took 4 years to come back to this break-even point. Let me show you right here. And They had to put off retirement 7 years. They felt like they had lost their future. Then what happened in 2008? It lost 40% again for the second time in a decade in one single year. It took 4 years to come back to $1,046,000. We call it the lost decade because people made money, lost money, made money, lost money. And do you know that many of our clients using indexing, they did not lose when the market went down. They may not have made much, but as soon as the market turned around, they started making money. When the market crashed again, they didn't lose anything. And then they started making money. They ended up with $2 million and even $3 million at the end of that 12-year period when most Americans barely had their $1 million back that they started with. Have I got your attention? People say, well, I've never seen one do this. I have financial advisors, naysayers who go, well, I've never seen one of these indexed universal life policies actually do this. Oh, really? So since you've never seen one, you don't think it exists? How do you know your brain exists? Have you ever seen that one? No. Well, yeah, that's the kind of reasoning they're using. So here are some actual statements. When our clients get statements of indexed universal life, this is what many times they will look like, and it will show how they've allocated it between the different indexes or indices. And sometimes people leave it in the fixed account. This year, it was 9.32%. That's not bad, 9.32%. You wouldn't believe how many advisors go, I've never seen one earn more than 2 or 3%. 9.32, this is very common. Here is one that was primarily into what is called the 5-year high par. Okay, this was 9.96%. We have many people who will diversify and have 20%. Let's say they have $1 million. They have 200,000 in each of 5 different strategies. Here, this client earned 14.89% on 1/5 of their money. If they had $1 million, that would be 200,000. 10.25% on another portion, 15% on another, 8% on another, 13% on another. When you add all these up, many times they're averaging in excess of 10%. They've experienced this year after year after year, some years higher than others. Here is one of my favorite. This is where a person actually started out and they were diversified, and look at this. They had 84,000 in this one. They got 61.33%. This is March of 2020, ending March of 2021. They made $51,000 and they ended up with 135,000 1 year later from the 84,000. We had many people who got 61.33%. This is a 1-year point-to-point no cap strategy you can learn about on this channel. Here's another client that got 61.33%, 7 1/4 on another, 12 on another, 9 on another. You can bet they were going, I wish we would have had all of it in the 61.33%. But 18,000 grew by 11,500, and they had 29,000 at the end of one single year on that portion. Here's another one. As of the recording of this episode, this just happened in the last few months. This is in the year 2021. This client had 468,000, was credited 61.33%. Why? Because in March of the year 2020, the market dropped 30%. My sons were the advisors, and they said, link. Yeah, that's why it's so important to have an advisor that knows what they're doing. They linked, and 1 year later, with this annual point-to-point with no cap, March of 2021 was predictably going to be pretty good, 61.33%. They were credited $287,000 on the 468. They ended up with 756,000. We had other people experience the same thing. Here's somebody who got 30.76%. Here's another person that got 28.8%. Here is another person that got 12% on a portion and 28% on another. Why am I doing all this? Again, I've taken their names off of here to protect their privacy. But when I have advisors out there say, well, I've never seen one that has done very well at all, I can show you hundreds, if not thousands, of statements where people have made 20, 30, 61%, and the gain is locked in. If the next year the market crashes, they don't lose a dime. That is called lock in and reset. Here is where somebody received 12% on a portion of their money, 30% on another. If you want to look at actual performance, the insurance companies that offer these will usually show you year by year, month to month, the rates of return based on actual history. You can study and see, here's 25% that was credited on all of these statements all the way back from 2021 going back to 2018, 2017. It's actually been a heyday for many of our clients. In 2017, we had clients lock in gains of 25%. People who had $1 million made 250 grand. They had $1,250,000. If the market crashed the next year, they did not lose the $250,000 they made the year before. That's called lock in and reset. So this is the key to be able to have 1 year point to point, or maybe 2 year or 5 year. Search this channel and learn about these various strategies that you can employ, and you can then retire by design. Let me show you how to claim your free copy of the Laser Fund book. So here's how to claim your free copy. Go to LaserFund, L-A-S-E-R, fund.com. Click on the link below. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that. I'll fire out a hard copy to you. This is 300 pages. And it's actually 2 books in one. As actually shown here on the screen, this white cover side is about 200 pages, 14 chapters with all the charts and graphs and explanations of how the Laser Fund allows you to accumulate, access, and transfer your money tax-free, and you'll understand indexing. If you learn more by stories, you flip the book over to the orange side, about 100 pages, 12 chapters, with 62 actual client stories of how the Laser Fund is used for all kinds of financial goals. So if you like to listen and learn, watch and learn, there's options there. But I want you to claim your free copy and then empower yourself, subscribe to this channel, click the bell, be notified when I post a new video almost on a daily basis. I don't want you to miss out.